Wednesday, June 21st, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at inflation again today, especially here in the UK. We've had the CPI and RPI data, and we've also had the budget deficit data, or the public sector net borrowing requirement. They make it seem so arcane, and people don't look at it. They could just call it budget deficit. It would make it too easy for people to notice, I think. And we're continuing to see record deficit spending, the biggest on record for the month of May. And we're continuing to see negative real rates as per the Bank of England base rate. And that's why we have rising prices. That's why we have what is called inflation as per the CPI. And why do I say that? Well, because CPI and RPI, they don't cause inflation. They're the consequence of inflation. And what is inflation? That's what we're going to look at today. And one thing I wanted to tell you, if you're concerned about the price of gold or silver in British pounds, I personally am not. Yes, it's frustrating to see what's going on in this country and to see the pound go up so much. It doesn't make sense. Not that I want the pound to collapse, but things are much worse. So what do I think is happening before we go into the news that came out this morning in terms of the markets? Well, I think governments and central banks, when they're desperate and they're trying to keep investors on their side, they will do anything necessary to give the wrong signals. And what do I mean by that? Well, they will use what's called the exchange stabilization account or equalization account. That account was opened by the UK back in 1931, and when the UK left the gold standard, and it's still around, and it's used to stabilize the value of the currency. And of course, the gilt market is very important for the currency. And yesterday we saw in the middle of the day the 2-year gilt magically drop from like above 5.1% to below 5%. And one of my friends even noticed that and sent me a message and said, well, looks like someone intervened in the gilt market. And someone's also intervening in the gold market. And how do they do that? The Bank of England? Well, unfortunately, there are a lot of central banks out there who should know better than to leave their gold with the Bank of England. Bank of England has got 5,000 tons of gold that is not theirs. That's kept with them for some reason by many countries, and they will lease that out to the bullion banks. Bullion banks will take that gold that's leased from the Bank of England and sell it into the market, and then receive dollars for that. And with those dollars, they will buy British pounds. So it's a double whammy. They smack gold, they take the dollars, they buy pounds, they make it look a lot better, like they're putting lipstick on a pig. And it can't last forever, because people are going to wake up to the fact that inflation is a deliberate government policy. And why do they do it? Well, because our government is up to here in debt, well, in the US as well, everywhere. And the only way they can keep going is to extract wealth from the public. And how do they do that? Well, they issue a lot of debt, a lot of currency. They devalue that currency and they use it to buy things, to buy votes, while the general public, they get that currency later and devalued. And that's why prices are rising, because it's the simple law of supply and demand. And I'm going to quote again, and I don't tire quoting Felix Sommery, because he was a very influential banker in the first half of the 20th century. He was originally from Austria, then he moved to Switzerland. He advised the United States during the Bretton Woods Conference, or in the run-up to the Bretton Woods Conference, and this is what he said in his memoirs, and I quote, "The state alone is responsible for inflation. Inflation without government, or indeed against government, is impossible." So there you go. And we keep hearing, of course, from Jeremy Hunt, the Chancellor of the Exchequer. For those of you who don't know what the Chancellor of the Exchequer is, well, he's the equivalent of Janet Yellen, or the Secretary of the Treasury, or in Europe, better known as a finance minister. He keeps saying that they're going to have inflation or the CPI. That's the other way they fool people into thinking that they're not the ones inflating. They call the consequence the inflation. It's like saying that if you're overweight, your tummy made you overweight. No, what made you overweight is that you ate too much and you didn't exercise enough. And it's the same thing with inflation. So I'm afraid Jeremy Hunt is speaking with a forked tongue. He keeps telling the public, and he's trying to convince investors that they're going to be good. They're going to have inflation. Well, even if they have the CPI, it will be around 5%, which is still a huge tax on the public. So before we look at what came out today, I want to show you why we're having this inflationary problem. And the only way that they will stop it, I'm going to show you, just showing you a chart. That's the only way that they can do it. So I've got here a chart that I plotted, and I've got RPI, which is the blue line, which is the retail price index. Why did I use the RPI? Well, because that used to be what people, the government and markets used as a measure of prices or inflation up until New Labour came to power, and they came up with this CPI, which is not really a good reflection of the cost of living for the average household. So we used that. So we've plotted the RPI, the annual change, percentage annual change, and the green line is the Bank of England base rate at year end. And prior to 1975, it was the Treasury discount bill. So what you will notice here is that, with the exception of like some short periods in the 70s, the green line, or the Bank of England base rate, or the discount bill, Treasury discount bill, is substantially higher than the RPI. And why is that? Well, that's in order to keep inflation in check, to keep prices under control. And you can see why in the 70s they had problems with prices or inflation, because in the early 70s, the Bank of England base rate, or the discount rate, was below the rate of inflation, or RPI. The same thing happened in the mid 70s and in the late 70s. And it was only when in the early to mid 80s that they actually targeted the money supply, and they allowed the rate to be way above the RPI. That's when they're able to bring a semblance of not price stability, I don't like that term, but of disinflation. But now I'm going to show you something that has never happened before. And yes, rates are very low, but as you can see, since the '08 crisis, the real rate, and this is called the real rate, has been negative. So it means that still today, you're getting paid, if you're a big borrower, like the government, the Treasury, they're getting paid to borrow. And how does that work? Well, you've got RPI, the latest number is still around 11.1. I think it's gone up yesterday. Today it's gone up to 11.3, while the Bank of England rate is at 4.5. So that's why we have inflation. And when and how can they stop it? Well, they can stop it by raising rates way above where RPI and CPI are. I would say they need to be in double digits. And if the Bank of England is really serious about doing that tomorrow, they have their decision, they should raise it tomorrow to 10%. Of course, they're not going to do that. They're not going to do that because it would cause a major crisis. And I think Andrew Bailey would be out the door as quick as you can say Jack Robinson. So he's not going to do that. And that's why this is going to continue. What's the danger here? Well, the danger is that the general public realize that this policy is deliberate, that it's not going to stop. They're going to keep inflating, and they react accordingly by getting rid of the currency as quickly as possible. And that could develop into very high price rises or inflation, if you want to call it that. And eventually it could even result into hyperinflation. So, I mean, this is a great opportunity if you've been fortunate enough to have savings to protect yourself, in my opinion, with gold and silver. They're at a discount right now, I would say, especially in British pounds. I would be loading up on it personally, and I have been in the last few weeks. And I would be doing more if I had some spare fiat, but I don't at the moment. But what else came out today that convinces me that the UK government and the Bank of England are working together to financially repress savers and keep this Ponzi going? Well, it's the UK public sector borrowing requirement. So that number, that statistic came out today at the same time as the CPI and RPI data. So that was expected to be 14.9 billion deficit or net borrowing requirement, but it was actually almost 20 billion, 19.22 billion. And this is the most borrowing in the month of May since 1993 when records began. So a 30-year, the biggest borrowing in May for 30 years. So a government that's looking to have inflation is borrowing at a record pace. It doesn't make sense. That's why I said he's speaking with a forked tongue. And this is why they've borrowed so much. It says UK monthly public sector borrowing more than doubled in May, boosted by higher social security benefits and additional energy support schemes. So let's quickly go through these CPI and RPI numbers before we look at the markets and the gilt market. So core CPI, which is really the CPI without the volatile components like food and energy, that's a problem because it actually rose from 6.8 to 7.1. It was expected to remain unchanged at 6.8. And these are all year-on-year changes. So not good. So what about the CPI, the headline number? Well, that was expected to drop from 8.7% to 8.4%, but it stayed at 8.7%, so no good. What about RPI, which I think is a much better reflection of the cost of living for the average household? Well, it was expected to drop from 11.4 to 11.2, and it dropped to 11.3, but it's still double digits. And we're seeing now another problem come up, which is the housing market, all the mortgage rates going up. And why are mortgage rates going up? Well, because gilt yields are going up, because people or investors are waking up to the fact that this is a deliberate inflationary policy, and they don't want to hold government bonds that yield only a 4% handle, while the currency has been debased in the double digits. So we're already hearing people in government and other politicians and other commentators saying that the government has to step in to help the real estate market, mortgage people with mortgages, and well, that's another way of printing money to help a cost of living crisis. It's only going to end in tears if they do this. So that's what's going on, and you need to remember that inflation is a deliberate government policy. Back in the day when you only had gold and silver as money, gold and silver coinage, the only way to inflate the currency, like the Romans did, was to debase the coins. Let's say an aureus, a Roman coin, had so many grams of gold, and if the government wanted to spend more, and they still wanted to call it an aureus or whatever denomination it was, they would inject a little bit of base metal, make it still look like gold, but it was actually inflated. Inflated, it means that there's still the same denomination but less gold, and that's what it's all about. They did it also to the denarius, the silver coins, and by the 4th century, there's almost no silver left. But nowadays they can do it through just issuing this paper money or digital currency that out of thin air. And it's only the government and the banking sector that can do that. We can't do that, of course. And the Bank of England and the government work together to keep this Ponzi going. But I'm afraid people are waking up to it, and investors are waking up to it. So that's what's going on. So it's 20 past 8 a.m. London time. So we're going to jump right to the gilt market because I think that's important. So as I said yesterday, we were trading above 5.1%, about 5.11, I think. And all of a sudden in the afternoon, it dropped below 5%. I'm convinced they knew what the numbers were going to be today, and they did that to cushion the blow that we'd have today, because right now we're up 18 basis points, but we're pretty much where we were yesterday early in the day at 512. That's where we are right now, 5.12%, the 2-year gilt yield. Even the 10-year is up about 12 basis points. The 30-year is up about 10. So let's quickly look at the other markets now. So we've got spot gold, pretty much unchanged at 1935. The high's been 1940 and the low 1931. Spot silver's at 2308, down about 1/3%. Dow futures down 45. NASDAQ futures, 100 futures down 25 points. S&P futures down 6 points. To the currencies, sterling is unchanged, 127.63. And I think this is just temporary, the relative strength of sterling versus the dollar and also versus gold. I'm sure also the Bank of England, aside from leasing gold and buying pounds with the dollars, they're also using the Fed swap line, which back in March, I think Powell announced that they're going to have daily swap lines. So they're making use of that as well. But that won't last forever, in my opinion. The euro is unchanged. The dollar is up 1/3% versus the yen at 142. And let's see, the dollar is up 1/4% versus the yuan, just below 720. Aussie dollar is down 1/3 at 67.66. The dollar's unchanged versus the Canadian dollar at 132.36. and the Kiwi dollar is unchanged at 61.68. Now to the commodities, general commodities. We got WTI crude up 0.5% at 71.50. We got Brent up 1/3 at 76.12. We've got platinum down $5, trading around 960. And high grade copper is unchanged, trading just below 390. So I'm going to end at that and wish you all a very good day. Take care. Bye.